Hey everyone. You know, a generation ago, real estate investing was a very local business. Today, investors have become increasingly sophisticated with access to better information. They have access to more markets, and they have access to high quality professional management in markets all over the country. One of the top trends in the commercial real estate market has been the migration of capital from one city to the next. Investors can pursue yield, opportunity, specific price points, target growth markets, or different asset types. Now, the advantage of all this for sellers is they have more exposure to buyers from all over the country who may have different needs and investment criteria than the local investors. In addition, for buyers, they have access to a national inventory of listed properties of all types, and that helps them with their portfolio management and diversification and allows them to pursue higher yields. This all brings more liquidity to the marketplace, and that's good for buyers and sellers. There's been a really significant trend. In 2000, 61% of all commercial real estate transactions were in primary metros. In the last year, 61% of all commercial real estate transactions were in secondary and tertiary markets. This is a complete reversal of where the capital is flowing, and that's driving investment trends across the country. Now, retail properties have been at the forefront in this movement of capital, largely because single tenant net lease properties can be all over the country. So 66% of retail transactions are in secondary and tertiary markets. Apartments have the least movement of capital. There's only about 53% of the transactions are in secondary and tertiary markets for apartments. Office, it's at 62%, and industrials at 61%. So what are the drivers of moving capital across the country? The first thing is yield. Cap rates in tertiary markets average about 130 basis points higher than in primary markets. There's also the opportunity to capitalize on a market transformation. If the timing is right, smaller cities have the potential to grow and appreciate faster than the larger cities. A single market might be impacted by a single company or employment sector growing very quickly. So over the last 5 years, commercial real estate in primary markets has appreciated by an average of 35%. And that's pretty strong. However, Portland, Oregon has grown by 46%. Austin by 52%, and Orlando has grown by 61% appreciation over the last 5 years. So you can see that on a local metro basis, you may see a much larger influx and growth rate than you see on a national level. But that also works in reverse. There's more risk associated with some of the smaller cities. So what are some of the key considerations? Accessibility. You have to be able to get down and visit those properties and visit the market. Management is a key factor. You have to be able to access local management for these properties. So there are economies of scale in play. You may want larger assets or more assets in order to make the management make sense. You also have to understand the local market forces and the local taxes, because different states have different tax rates on real estate and income, so that's something you should understand as well. The key ingredients for this are information. You have to be able to pull information on markets across the country. You have to build your knowledge base about what's driving that local market, and you have to develop expertise. You have to know the opportunities, and you have to know the risks when you're investing in other cities.